Hey, good morning, good afternoon. How is everyone doing? Great weather in Michigan. I mean, in Bay Area, it's nice. It was a little unusually cold during the week. I don't know why. I guess climate changes and all that stuff. But yeah, no, it's back to uh, being normal, which is great. All right, what else happening? You're in 60s. That's cool. That's nice. That's nice. Any new stuff? Any new learning? We'll get on to our markets on our discussion in a moment. Hey, hello, Ross. How are you? What a week it was when it comes to the market. I thoroughly uh, enjoyed the happenings in the market. I see some comment around Elon. Elon is what he is. He is the richest person in the world, and he thinks he can do whatever he wants to, and he's doing it. So, yeah, it's not been a good week for many people in the tech industry. It's not just, I would say, Twitter, but many other companies also reported, basically did a layoff. So, especially the tech labor market, that's not tight. A lot of, I would say, job layoffs happening on the in the tech companies, though. Okay, all right. I had to bought a Powerball ticket. No, I mean trying the luck. I think now what it's the price is over $1 billion now, but you might have 1.6. My gosh, yeah. So there's something which I've not tried. Maybe I should. Um, but I like to play the odds, and that's why I do option is to increase my probability of wins. And in case of Powerball, I think the probability of winning it is 1 in some close to 300 million chances. That's a probability I don't like of probability of win. I want to have a more than 50% chance. Otherwise, it's a coin flip. VIX is creeping lower, a calm before the storm. I don't know. I think the other reason why VIX hasn't gone high as much what we'll expect it to. If you really look at a VIX, it's still like, I think it was 26 or something, right? Or 25. And it's been, while the markets have gone up, it's been, oops, sorry, I should change it to not the percentage. Okay. Yeah, it's crept from 32 to 24. I'm not sure it's a calm before the storm. The VIX went high in anticipation of FOMC meeting, and we will talk about it whenever. Now the markets move more by what Fed chairman has to say than what the actual happenings in the market. So I think in anticipation of that, VIX has been creeping higher, and now that event is over, right? It's a Wednesday. We heard from Fed. And whatever had to happen at that point of a time, market did whatever it wanted to do after the announcement, and now VIX is back to it crept lower. The other is lot of institutional funds, they're already well hedged, so that's why we may not see a lot of activity in the VIX, because otherwise, based on how the markets have been behaving, thinking that the VIX is actually under 30, it sounds, a little abnormal. Generally, looking at the movements in the markets, VIX should have been much higher. This whole year, if you look at the whole year from a year perspective, I think it's a very few times when the VIX actually is above 30. Right? Most of the time it's been below 30, which is, if you would have told me without looking at the S&P 500 that VIX has stayed below 30 this year, I wouldn't think that the markets are as bad as they currently are. So several folks on Twitter are saying 2022 VIX looks similar to 2008, maybe. Let's look 3-year. So this is where we had that whole COVID spike. And after that, VIX has been pretty much range bound for since, I would say, mid of 2020. It's been between 35 and 15, or rather closer to 20. Between, let's say, 30 and 20 is where VIX has spent most of its time. Who knows if this is being manipulated like gold and silver? Maybe, but I don't know. I think this market is big enough, so I have no idea how it's being manipulated, or if it is being manipulated. But as you can see, it's been pretty tight range bound, which is surprising. 20. Oh, okay, so I read that 2022 VIX looks similar to 2008. I do know. I think there was one big trade on VIX for 2023 March or something like that, around 150. Somebody bought a bunch of calls. You know, a big unusual options trade is somebody loading up on VIX calls for, I guess it's February or March 2023. I don't know if someone knows something or it's just that a bet, but it was one big trade that was done. Let's see if we can find that. Sorry, it was 100 and I think it was even further down, 150, yeah, 39,000, 60,000. This one 75 is 203,000 for March one. It's a huge open interest on VIX at 75. VIX is low, market is low. This market will do a slow creep down. Kind of, yes, and that's what we've been witnessing for the whole year. Is it's like death by 1,000 cuts. Right? It's not over in one fine, a big chop. It's been slowly markets have been moving along. Look at creeping down or sideways, and that's oops. Let's look at 1 year. It's been smooth progression in the downward on the downward side. Right. So we'll see a few weeks. We'll go down, come back up, and then it'll continue to make lower highs and lower lows. We'll see. Maybe 350 is where so this one huge spike in mid of October when it went below 350. Maybe 350, 360 is where we see a lot of support level. I mean, it respected that over here. It's over here. Almost over here is maybe that's where a lot of buyers are coming back in, thinking 360 is a good point to enter. But no one knows if it indeed is. Bank of America analyst says, yeah, start to nibble when it has 360 and, start to take bigger bites when it has 330. But we thought that this Q3 earnings, we were expecting the earnings to be worse than what earnings are being posted by companies. Right. This was a quarter in which we thought, okay, multiple compressions has been done. Maybe we will now start to see earnings compression, but except the tech sectors, not much. Earnings have been surprisingly better than expected. But of course, the big market cap companies are were in the tech side. So we did see market still being weak. But other than that, I mean, healthcare has been strong. Financials have been okay. Oil has been through the roof. Oil, energy, industrials have been doing great. So let's look at industrial. This whole earnings season has done great. XLE for energy, my God. Energy, if you look at last from end of September, XLE, which is a ticker for energy ETF, end of September, let's say around 70, all the way to 90. That's like $20 jump on the basis of $70, which would be around, what does that make? 20 over 70, it makes how much percentage? Almost 30%, like 28% in a month. So yeah, there are sectors that individually have been doing great. Whereas the tech sector, let's say communications, don't even want to look at this. QQQ, QQQ, yeah. But yeah, I think overall we have a slow grinding going down, and that's why it's becoming, for many people who are kind of losing patience also. How long will this continue? But it is what it is. Nothing much we can do about how the market behaves. What an interesting one. Earnings are intentionally put at low bar, which are now being beat. I don't know but I do think now we are seeing a lot of companies maybe sandbagging the earnings. Well, we'll see. Maybe a good idea to play inverse index ETF. You could, but I would rather continue to focus on. And I don't know what, when you say play, means what, you buying an index ETF or buying a leveraged one or buying calls or selling puts. I mean, there are multiple ways. So my still preferred way, at least, which has worked beautifully this year, is to either do the covered calls on the stocks or basically call spreads and the naked calls on the indices. All my delta reduction has been through either the naked calls. If it comes to QQQ, IWM, SPY, that's all naked calls. So basically shorting the calls on those, and doing call spreads on SPX, NDX, and RUT. These are my go-to trade for this year. And then on individual stocks, yeah, do a covered call or a call spread. Those are the best ones. I mean, on this Friday, there was another SPX trade which got closed. Some decent dinner money. So, but those are the at least from my perspective, those are the ones that have been working good for me, and I'll continue to do that for reducing the deltas. Inverse, I've never played on. Again, from a leverage perspective, if you are looking at a leveraged inverse index ETF, then yeah, you can't hold it. It's not a long, you can't hold it for a long term. It's just a short-term trading instrument. In fact, I heard on EEM, there's a leveraged one. I don't know which one is that. Maybe we'll have to see. But EEM, which is emerging markets, it saw a huge jump from close to 34 all the way to 36. It's like almost 10% jump on a single day on emerging markets. China was the story for this week, while the the S&P 500 US markets haven't been doing great, but Chinese stocks. So if you have some Chinese stocks in your portfolio, that part of a portfolio was smiling this week. All right, so let's get into today's session. I realized today's 150th session, right? That's amazing, at least from my perspective. We started with two or three people, close friends, and then expanded the group. And today, I never knew we'll continue till 150th session. So happy to be here. Thank you to you all for joining every week. Here we are, 150, still going strong. Let's continue to meet every week. I look forward to these sessions. It gives me a motive to do something good, something productive on Saturday morning, and also forces me to go back and look at what's happening in the markets, so that we can come here, we can talk about it, we can discuss, and become better investors. So thank you to all. Today is 150th session. Another year we should have celebrate our 200th. So what we're gonna look at today, Ramesh, I booked Saturday till end of 2022. so thank you. At least I have one who will be there till the end of 2022 with me. All right. So today I do want to touch base on FOMC, and we'll also look at how crazy the market is. And I'm sure these are some of the algos which are doing analysis on the words that are being streamed out of a press conference, and based on the semantics, based on the words that comes out of a Chairman Powell's mouth, markets just go crazy, right? It's by the way, I was because of Wednesday, I generally go to in person. I go to office, and I was in office, and I was to get into a meeting, and then I saw market went higher. So I thought, okay, maybe I need to add some more deltas. So I converted one of my call spread to an iron condor, and then I went in a meeting. And then I was in a meeting from 11 o'clock till 1:30. And then I didn't have a chance to look at the market. Only in the evening, one of my colleagues tell me, you know what's happened in the market? I said, no. He said, oh, S&P is down by 2.5%. I'm like, what? Because when last I looked at it, market was up, and I added a little more delta. And then I was like, okay, I don't know, maybe tomorrow I look at it and see if I need to defend that or not. But eventually, all that worked out fine, because it was expiring on 4th of November and the market recovered. But yeah, that's how the markets behave, right? Especially this on Wednesday, it was like a topsy-turvy. So we look at that, still it's an earnings season. Do want to look at some of the stocks that I hold in my portfolio: Uber, Airbnb, Block, and Mercado Libre. That's main stuff. And we'll look at some interesting charts as well. As always, everything we talk here is entertainment, education, not a financial advice, guys, not a financial advice. I don't know. You guys had anything else in mind? What else caught your eye?
What about the market? Do you think there's another leg down, further down?
Again, I am no market forecaster, because that's been a losing game. But what I hear from various so-called pundits is, especially people like Stanley Druckenmiller, people who have had credentials, they say, yeah, worst is yet to come. But markets are very tied to interest rates. So while it might continue to go down slowly and steadily as what it has been doing, if we get any signal of Fed pivoting, is going to completely move into opposite direction. Right? And when that pivot will happen, no one knows. So this week, we thought maybe Fed will come and pivot because the Bank of Canada last week raised the interest rate by a lower percentage than what market was expecting. So we thought maybe Fed will also have a similar undertone, but no. So, and I don't want to, and I'm not answering your questions because, to be very frank, to be very honest, no one knows where the market will go. So I don't want to position myself with any definitive direction saying I know where the market is going, but I do want to play and stay in which, even if I'm a little bit wrong, we are still able to make some money and still stay in the market. Now, looking at the history, and history doesn't repeat always, but it does rhyme. Recessions, on an average, market has gone down 35%, 35 or 38, something like that. Right. So far, we've been down, what, 20, 22%? So looking at the old data points is where we are seeing a lot of pundits coming in and claiming that there is still downward possibility that the market has still more to lose. I've heard of S&P reaching up to 320. That's where S&P might find its bottom. Right? But things have changed. Historically, Fed never had so many press conferences. Fed governors, never had so many speeches, but now they do. The FOMC meeting used to be a non-event. Now the FOMC meeting and a press conference after that could make a difference of a few $1 trillion in the market. So I don't know how much can we rely on historical data, but to look at, if we really want to put our bet on historical data, that shows that the market still has more to lose. But I'll be very honest and frank, I don't know where the market is going. So I don't want to be too negative, and I don't want to be too positive, but just control my deltas so that even if market is going down, I'm still making some money on the calls and the call spreads, and continue to hold the great companies that I want to hold in my portfolio. Sam said, I would like to explain something. Yeah, go ahead, Sam.
Vivek, I come from the generation that Bill Gates is evil. You remember Jerry Yang turned down the
offer? Yeah.
Yeah. See, but he didn't fire people like the way Elon Musk did, over text messages. I mean, that is really.
I mean, we have seen worse. I think one of which was one mortgage company, Better.com, CEO fired people in a Zoom meeting. So yeah, there are weird people. I mean, we can't control how people behave. And I know in a lot of, I think on the Twitter side, it's almost 50% is his target. And he has to do it because he overpaid for Twitter. I mean, so now he has to cut costs. He's losing advertisers. Many advertising companies have paused their advertising on Twitter. He's trying to raise money by charging $8 for a blue check mark, and you increase your top line or decrease your cost. So, and now it's decreasing the cost by laying off the employees. Okay, that's not you're saying that's not an employee fault. I completely agree, but this is the capital market. And one thing I do agree, that Twitter employee base was bloated. I mean, you don't need 8,000 people. How many employees Twitter had? I think it's around maybe 8,000 or something to do what Twitter is doing. So it was surely bloated, but could there have been a better way to do this retrenchment? Of course, I think Stripe has handled it really well. Even Stripe did a Again, Stripe was one of the great, one of the best unicorns of the last year, previous year. At one point of a time, Stripe valuation was close to $90 billion, of course, in the private market, because it's not public yet. That was the most valued startup unicorn in the world. And now this week, I think Stripe cut down its workforce by, I don't know, 15% or something like that. Let's see. Stripe, hold on. I'm just. Okay, Stripe layoffs. 14%. Yeah. So yeah, I was close, 15%, 14%. But what I read somewhere was that they did it really in a nice manner. Right. It was one of the best ways in which Stripe handled this. On the completely on the opposite side was what Elon had done. Yeah, different CEOs have a different ways of handling this. But because it's at least on the Valley, it is pretty common. We saw Stripe. Even I heard Morgan Stanley did. Argo AI closed the shop last week. Twitter has done it. There are many companies who have cutting the workforces, and some of them were always bloated. They hired the best engineers as quickly they could, and then they decide, okay, we'll find the work for them later, right? And when the interest rate was zero, you could afford all that. But now the customers, the investors are looking for cash flows. Investors are looking for profits. So you have to cut down on your expenses. But it is free market. Employees are free to go whenever they want to. So employers are also free to fire whenever they want to. I mean, it is what it is. It's hard for those who go through this. I've gone through this in my life as well. But then it's a choice that we make. Or best is, all right, let's become entrepreneur, become business owner so that no one else can fire it, or find alternative way to make money, increase your side hustle, do investing, Airbnb, Uber, figure out other ways to generate some additional income so that you're not dependent solely on your employer's income. Right? That's the reason why I got into looking at focusing on options. Is there's a way to at least continuously generate some dividend or generate some income and get into investing so that I'm not dependent only on my W-2 income. Yeah. It supplements right now. That's great. Let's say if I want to retire sooner, at least I have another way to generate an income and support myself and my family. All right. Twitter has no shareholders. Now they don't have any more. But they do have investors. There are investors who put money along with Elon Musk, his friends and family. They have added money. And eventually the idea is that Elon Musk is right now behaving how a PE firm would behave, private equity firm would behave. So the other way they could have done is work it through a PE firm and have them do exactly what Elon is doing, right? This is a pretty standard playbook of any PE firm. You get a company, cut cost, increase the revenue by a bit, and polish it up and bring it back to the public market in a few years. And that's what Elon and have given signals that maybe they'll bring it back to public market in a few years. So to make it more attractive, the business has to be viable, business has to make money, make profits, and that's what he's doing. Could he have done in a better way? Of course, right? I didn't like the way he has done it, but I won't blame for him. He's got $44 billion. He's put in $44 billion, and he needs to make sure he can, trim it. And it was an expensive one. He wanted to get out, he couldn't get out. So now the idea is to let's reduce the cost. So coming back to our macro side of the house, Jack, I see a not so good comment about Jack Welch. But if you go back, and when I was in a school, in college, Jack Welch was considered as the top, corporate CEO in the world, right? In the world. And he had his own way of managing the companies. I remember specifically reading the book called the GE Way or the Jack Welch Way. There were two books that he wrote, and I read both the books. No, it's been more than 25 years, right, since I read that. But yeah, those were like a recommended books for college graduates, is to understand, how the most respected CEO in the world, what he does, right? Now you can come back and say, oh, that wasn't a really great way of managing the companies, but those were different times. I mean, and at that point of a time, GE was one of the most valuable company in the world, if not by market cap, but more than by brand, right? Conglomerate, managing so many multiple businesses, and but it worked during that time. Probably that way of management may not work now, right? Elon is one type of word, but Elon is proving that that style still works. All right. Coming back to FOMC, Wednesday we got heard from in the press conference that raised rates by 75 basis points. That was pretty much expected. I don't think markets had anything to, the movement of markets had anything to do after the 75 basis points. But what we saw, and I think this was a dovish signal, wherein just before getting into meeting, I was like, okay, looks like the markets are going higher. Let me do some increase some deltas. And then I was like, no, yesterday I was reading what exactly had happened. So this is what the comments from the chairman Powell, which is like, with the lags between policy and economic activity, there's a lot of uncertainty, blah, 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 blah. That's why I've said at the last two press conferences that at some point it will become appropriate to slow down the pace of increase. That's it. The market latched on to this particular sentence. The software read this, so that time is coming, and it may come as soon as the next meeting or the one after that. So algo started to kick in, saying, no, okay, Fred is becoming dovish, so Mars is going to go high. We saw you jump in the market. And then I think later on he made some other sentences, which is very premature to be thinking about pausing. We think we have a ways to go, right? And then the markets gave it all up. So this was just right before, so this was just around 11 a.m. Pacific, 2 p.m. Eastern time. Markets just shot up higher. And then after the next set of comments came, gave up all the gains and went. I think eventually it ended the day at 368. Yeah, so now I think that especially in a short term, it's very difficult to even think what's market going to do, because it's dependent on what comes out of a Fed chairman's mouth, right? Or any Fed governor mouth. So too many other variables that have been added. Yeah, so it dashed the hopes for a pivot. Of course, growth stocks will decline more. On an average, Dow Jones has held up much better. So industrials are doing good. Healthcare is doing good. I think Apple was still better than many of the other companies. So the Dow Jones was better, but it's the growth that got killed. You really like YouTube Shorts. I haven't yet warmed up to YouTube Shorts, or for that matter, TikTok. I don't know, but I know that YouTube is making. They are doing a lot to pay more to content creators on those who are creating content on YouTube Shorts. And there is also a chatter in the market on the ban of TikTok. And I do think that at some point of a time, we may see US government coming and banning TikTok. Could happen. But it will be some time before the it will happen only after the US investors could get out. So I was listening to some other on YouTube on respected VC around the chatter in and around the VC circles have been some of the investors and the VCs who have invested in ByteDance, which owns TikTok. There's already a share buyback going on. And once those US investors are out, is when probably we might see government, coming back and starting to ban TikTok. Today, if they ban TikTok, a lot of these big money, folks will lose a truckload of money, right? So, some part of a time, I think this government and the now we know who. I mean, it's not a secret. We know, especially in the US government is run by corporates, elected by corporates, and many of these decisions to ban or not ban is also dependent on who's going to lose money if the government takes some actions. So there's been some chatter around, let's wait for these elections to be over. Let's wait for this whole internal share buyback to be completed. And I think then we might see government coming and banning TikTok. Again, could be just speculation. So don't make any trading decisions based on it. But I did see some chatter on the market around the ban of TikTok, that it may be sooner than we may expect. Ramesh says Malay is up after election. Hope it recovers. Co-directors are buying shares. Shopify getting additional investment from Baron Fund. Yeah, Malay was good. So I was happy to see Malay going up. The other thing is, I didn't check in terms of how much is their revenue from Brazil. Maybe we'll check it. But while the dollar has been going strong, I think at least Brazil is one of the few currencies, Brazilian real, that has actually have gained value against dollar, right? Pound has lost value, yen has lost like 50% of its value, yuan has lost value. Most of the currencies in the world have lost value against dollar, but Brazilian real actually gained against dollars. So it could also be possible that the companies that have bigger operation in Brazil, when they report their results, it might be a little bit of a help from there. Anyway, so we look at a Mercado Libre results and see where they help. But again, I don't know how much of their earnings or revenue coming from Brazil, right? So, but it is possible. I mean, from a business side, I think business still doing fine. So we'll look at its earnings performance. See, why is Google Cloud still pursuing crypto fascination? They understand that you can't ignore this technology, and for them, it could be one of those various bets which they have been, making. So what? So they are running a Solana validator. They should have done at least a little better than running a Solana validator. But yeah, I mean, not just Google, right? So a lot of big VC firms and the tech firms have invested in a lot of crypto companies because the technology is here to stay. The speculators will somewhat of a time, will move out. What is this? When the tourists, there'll be time when in the winter you will see tourists living, and those who are here to build stuff will continue to stay here. So since I brought up crypto, I think crypto had a good week of, well, the markets didn't do that great. I think cryptos had a better week. So where we are. Yeah, so wow, it's above 21K, right? For a moment, looks like this they have little divergent than what the market is. And oh, Ethereum is up like to 1600 bucks. Yeah. So especially on the Bitcoins, there's almost no selling pressure. Especially the institutions, they are not selling, they're just holding and sitting tight. So as long as, again, this will be a small bet for Google, one of those moonshot bets. And if it works, it will work. I mean, it is here to stay. The shape and the form of these crypto projects will continue to change. Many of the 95% of these stuff will die, but others will still remain. So why not? Yeah, guess for GCP, whatever sells, absolutely. They have to catch up with AWS, Azure, and others. So sell whatever you want to. All right, labor market. So employers added 261,000 jobs above the consensus estimate. So labor market overall is still good. The unemployment rate is still rose because the participation rate has moved slightly lower. So I was looking at a participation rate, and we are not, and this is how many people. This is a little different than what you call as unemployment, because unemployment rate is calculated based on how many people want to participate, and out of that, how many people are unemployed, right? So it does not count the people who don't want to go back to jobs, right? Could be people have lost their job and then say, you know what, well, I don't want to go back. I just want to do a focus on the gig economy. I'll Uber. I'll become a dasher, right? And then, so those people are not counted in unemployment. But it does impact the participation rate. So what you're saying, even though the market has started to recover, participation rate is still less. It's like only 62%. And over the years, it's been slowly coming down. The participation rate is been slowly coming down. So, which is a little worrisome. And on a treasury yield side, we saw short-term rates climbing more than the yields on long-term maturity. So, which means the inversion continues. Let's see the 2 to 10-year inversion, right? So that's where we see where's my inversion? 10-year minus 2-year. To look at our yield curve, come on. Yeah, it continues to stay inverted. And now the inversion is, okay, so let's go back and look at, not from 17, but let's say 2019. So it starts at, let's say, 2000. So over the last 22 years, and it's still the most inverted. Look at last 22 years. So, and as we know, yield curve inversion is one of the better indicators of upcoming recession after 12 to 16, between 12 to 18 months. But 2-year treasury rose 4.75%. Guys, 4.75%. It's not trivial. These are the stuff that we don't see often. So if you have some expenses coming up for which you don't want to take any risk, and for next 1 to 2 years, here's an option. Treasury notes for 2 years are yielding 4.75%. So one of the safest instrument in the world. Stuff like, if you're saving for some college expenses, etc., and you don't want it to be subjected to stock market risk. Earlier, there wasn't any, much income you could have made on it, but now it is 4.75%. From indices perspective, everything ended up in red. Nasdaq is still down more than 33%, and S&P is still in bear territory. I think we've been seeing it going up and down for weeks together, so it doesn't bother me anymore. Overall, S&P continued its weakness. I think this is what after, I think during the week on Wednesday or was on Thursday, it went up and broke its losing streak, but eventually on the end, by the time end of a week, it's still down more than 3%. Like I said, energy, material, industrials were the outperformer, gaining 2.37%, etc., and the worst were the information technology and communication services, especially mostly the growth industries. No surprises over there. But what did surprise was in the Chinese market, a message was worth almost $500 billion. And again, this tells us how fickle the market is and how quick the algos are, to turn around and start to do a trade based on any tweet, any message that appears on social media. So I think this was what, Friday? Was it Friday or Thursday? Wherein we saw suddenly all the, I think we'll have it. We'll look at that. But nobody was sure who wrote it. And if it was written, was it even true? But there was a screenshot of 4 paragraphs which talked about the plan of Chinese government or to reopen the economy. One of the things that has been keeping the stocks and the commodities, Chinese stocks and the commodities depressed, not just Chinese stocks, but even the stocks that derive a lot of their revenue from China, like Nike's and the Starbucks of the world. And the commodities, they've been constrained by the fact that Chinese government still continue to follow their zero COVID policy. It means if they find one COVID case, they're going to shut down the whole block, the whole city. And there was a message that showed up, which, what did it say? It claimed that the Chinese number 4 official, Wang Huning, one of the 7 men on the powerful Politburo Standing Committee, they had a meeting, and the representatives said that speeding up the conditional opening plan with the goal of substantially opening by the March next year. Now, no one knows how much is the truth in this, but after this, and the markets just shot up, right? And the 2-day total was close to $450 billion, almost $500 billion worth. This message was. And anyway, I think the government came back and told, oh, no, this is not from us. However, there was another message. Then I'll go back to these is, okay, I don't have. However, I think what government told that they will no longer penalize airlines if they're ferried, passengers who are found to be COVID positive. So that continued to keep the momentum up, saying, okay, at least, so that was an official statement, saying the airlines won't be penalized if, if the passengers of that airline is found to be COVID positive. So it does give some indication that Chinese government is loosening some of the restrictions. But yeah, is it gonna, will they reopen by March 2023 as this post has claimed? No idea. Could be true, may not be true. That was just a speculation, and no one from a Chinese government has confirmed around opening by March next year. However, because this news came in, we saw, and now this is the weekly chart for KWeb. KWeb is screen shares China's internet ETF. So a whole lot of Chinese internet company in itself. That shot up from 80, it's had like 21% up in a week. Alibaba, the most recognized brand coming out of China, was up almost 12%. It ended the week up 12%. At some point of time, it was up almost 16% for the week. JD.com, a little smaller retailer, online e-commerce retailer, up close the week up 20%. Pinduoduo, mostly around social buying, closed the week up 19%. NIO, EV car maker, up 23%. And we had the international one. Let's look at FXI, which is more like a longer, a 5 year, 2 days. It was up 20, no, not 20, it's up 14%. This is more broad-based ETF for China, FXI, right? K-Web is more focused on internet companies, so it's very sector specific. But FXI is a large cap, just like, I could say that's like an equivalent of S&P 500. So overall, I think the Chinese market did really good this week, and that's after months and year of almost depressing results. So if we look at the this Chinese ETF, large cap ETF, has lost tons of its value over this year. It's down. Even after this jump, it is still down 40% for the year. It's a lot more to catch up, right? But it was good to see some nice bump in the Chinese stock holdings. What it also did was, and that also brought up EM, which is Emerging Markets ETF. We go back and look at 5-day, it was up 7%, 8%. Of course, it has got China, India, Brazil, and companies from these countries, but it was helped a lot because also the allocation and the weightage of China is higher in this. It was helped a lot by the positive movement in the Chinese markets. What I also saw was what I hold my portfolio, FCX, because I had a covered call on this one. And FCX is a copper commodity. So we saw even the commodities did good. This was up like 11%. I don't know where DBC went to. That's a commodity ETF. I do no longer hold this, but even DBC was up like 5.5%. So some hope of recovery, reopening of Chinese economy. That's a tailwind for the stock markets, right? But yeah, good to see some green on a lot of Chinese based companies. What else? Fear and greed index overall still in greed side, which is where it was last week. So let me ask you this question again. I think we looked at this chart maybe 6 weeks ago. Where do you think not we are, because this is going to be very individualistic, very individual. So where do you think you are? Capitulation yet, depression, hope, or relief? I don't think this week gave us any sigh of relief because the market ended up down. But what do you think? Have we capitulated yet? Where are you on this cycle? Or here on the fear, capitulation and despondency, and then start to move up. So between denial and fear. How about overall market state in this cycle? No one, we don't know, but I think as an individual, we can guess. Overall, maybe I think we are still here. We haven't capitulated yet completely, right? But sector-wise, some of the specific sectors, if you look at tech, I think we've already passed capitulation. At least again, this is what I'm thinking. Market could be completely different, right? So I think on the tech side, we are probably over here, right? Based on some of the earning responses that we have seen on some technology companies, but overall, I think we are still maybe something here. Again, it's all guess. It says, any luck with how to find listed companies buying back their stock? Okay, no, I didn't have a time to look at that one. Yeah, something that you need to work on. I think the market is in fear state. It looks like worse is yet to come. Yeah, that's what I'm like. The probably market is in here, but who knows, right? It's all guesses, and these all guesses are is also driven by what each individual is and what you and I think that where the market is. Okay. But yeah, will be interesting to see. Okay, yeah, portfolio pizza, because this is our first session after the completion of October month. And as I always do at the end of a month, in spirit of transparency, I do come and share what do I hold in my portfolio. Not a big change. It's not a big change in the top 10 holding. So the top 10 still stay the same. Yeah, only the last two had switched spaces because Airbnb had after earnings announcement. I don't know. The earnings are all good, but markets didn't like it. So it was punished, but so moved down slightly below ASML, but I think no change for me in the top 10 of my holdings. Cash is still the king. The biggest allocation still cash, almost 10% of investable portfolio is in cash. It does not count my emergency cash. That's an emergency. Outside, don't even look at it until an emergency strikes. But overall, I think not a big change in the portfolio. So still holding 71. Gosh, I need to reduce that count, but many of them are like a dust portfolio, means less than 0.5%. So I'm like, keep it there. That's like a lottery ticket. Recovers, it's fine. If it doesn't recover, anyway, it's like less than 0.5%. So we'll still hold it. All right, any surprises here? Sorry.
Do you buy puts or anything to protect?
No, I don't buy. I don't buy puts. Like I said, to protect, I will sell covered calls to reduce my cost basis. Because if you buy puts, you need to buy it when you know the market is going down. In our previous sessions, we looked at multiple studies, which has clearly shown that the buying puts doesn't work. It doesn't help your portfolio in a long term. If you buy puts and the market goes down next week, sure, you come out as a winner, but you don't know where the market is going to go down. So what, as an investor, if you are really protecting your portfolio by buying puts, you have to continuously buy puts after, every expiration period. And that just doesn't work out. I mean, we can go back and review portfolio protection strategies. Maybe, I don't know, when did we last review it? Probably more than 6 months ago. So buying puts is the worst way. But unfortunately, most of the retail investors go and just buy puts. There are better ways to protect your portfolio than buying puts. So maybe the better is to just, sell and stay in the cash, which I don't recommend. So I protect my portfolio by selling calls, selling covered calls, and continuously reduce the cost basis. Maybe you could do collar. Maybe you could do collar if you want to protect it for a short term, is selling a call and basically buying a put and sponsoring it by selling a call, a covered call. So those would be my go-to. Buying puts is the lowest in my priority list for protecting the portfolio. I mean, it doesn't work.
Other
And
than
it's not just
selling,
me.
Other
Yeah.
than selling covered calls, any other way to protect it?
I mean, so you could, instead of selling covered call, you could sell like call spread. Again, that doesn't kind of it reduces the risk. But when I'm looking at protecting, I want to protect or reduce the risk over a long term, right? If you want to look and buy protection, let's say only for a particular event, and then don't want protection, yeah, maybe that could be, buying a put. It will be expensive, but then it will protect you for that event, right? But no, I generally don't buy put. And hold on, let me just pull up maybe one quick the summary slide where we had looked at the multiple studies and the summary of it, the portfolio protection strategies. I know I had a deck as well, so one second. Was the white paper? Valuation, reasons to sell. Where is, there we go. Okay, it's been a while since we did that, but let's go. So we looked at, there was an in-depth study done, and this is just one. We looked at, over the last couple of years, we looked at others as well. Yeah, so we looked at protective put spread, and the collar. And where's the summary? Yeah, and the data was from March 2002 till 23rd March. It also included the financial crisis. So if you look at that data, protective put is this this one. This is our S&P 500. If just buying a put, it would have been here. So long term, again, I'm talking about long term, protective put doesn't work. So we look at it 1 month buying put, 1 month, 3 months, 6 months, 12 months. Protective put is the worst strategy of all, right? Only time it wins is if you buy just before the crisis, but that means you need to have a crystal ball, right? Yeah, so I see a comment from it. I'd rather buy a lotto ticket instead of buying put. That's what exactly it is. It's actually a lotto ticket. And then you need to nail down, in case of a lotto, you need to nail down the numbers. In case of buying protective put, you need to nail down when that event is going to happen, right? So that's why I don't buy put. So other things we looked at, put spread option strategy, right? In terms of how much protection does it provide? It has a very poor tail protection. Better would have been just divest it, move to cash. Then we looked at the collar option strategy, and it does provide for who are more concerned with the downside risk than the upside potential. It has a superior protection against both tail risk and a modest drawdown on both as compared to the buying a put or buying a put spread. Lastly, yeah, so these are the few things. That's why I rather, if you really want to protect it, I'll rather do collar. Today I'm more on reducing the cost basis, because the shares that I want to hold, I mean, I don't need these in the next 1 or 2 years. So even if it goes down, it's fine. Because I'm not gonna divest out of it. So I'll rather focus on reducing the cost basis. It says, when you say cash, are you including short-term treasuries? What do you think keeping in cash is a good idea instead of putting it at work in the market? So hold on. So this cash, right now, this cash does not include short-term treasuries, but I do want to include it going forward. Because I only, I started buying short-term treasuries only in October. So I need to update my tracking way of adding, that into the cash. So right now it does not, but in future it will. I just need to spend some time to make sure I add that value. So yeah, so this would be high. So right now, this includes the cash which is on my, let's say, savings account, working capital cash, not emergency one, and cash which is uninvested in my brokerage accounts. Since you asked, let me make sure, is that the thing, or did I already include? Hold on, just give me a moment. Just want to make sure. Oh, no, it does include T-bills. So I did make a change. Yes, I see a note. It does include the T-bills. Okay. So why do you think keeping cash is a good idea instead of putting it at work? Because I want to be opportunistic also. I'm not keeping, cash out completely. It's just a 10%. So if let's say market goes further down, I want to put it for work. Right. So I still continue to invest on a regular basis in terms of my 401ks, not stopping that. Still continue to invest in kids 5 to 9K. I'm not stopping that. This is one, if I have let's say I have a put spread or I have a put, and then in that case, once the market goes down, I will be able to buy those stocks at a cheaper price than where they are today. And that's where that cash will come handy, right? I'm of opinion, always keep some dry powder to take advantage of the market opportunities when the opportunities present themselves. Am I sure that the market will go down? I have no idea, right? Those who've been on this journey with me for 2 years, no, I'd never claim to have a crystal ball. And anyone who claims saying where the market will go are not being honest with themselves. So I do want to, if market goes down, I do want to hold some cash so that I can take advantage of it. But if market doesn't go down and continues to go up, I don't want to hold too much cash in my portfolio, right? So 10% I think is decent enough, which is to allow me to hold cash in my portfolio, as well as also be available to take opportunities when the market will present. What is my beta weighted delta of my portfolio? So SP, I only have it calculated on, let's say, not on retirement account. It's only on my TD Ameritrade trading account, I can say, but I am looking at to keep it somewhere. If the market, right now the market is at what, 370, S&P, whatever, 370, 372, 375. When the S&P is 375, I'm okay to hold my beta weighted delta between, let's say, 750 to 1250. If it goes higher than 1250, I'll reduce it, right? Or let's say between, 750 to 1250, or 500 to close to 500 to 1000. Today, I think mine is around 800 or something, right? Last week, was it last week when the markets were down to 360, etc., or was it earlier this week? My beta weighted delta was down to 400, right? So that's where I added some more deltas. But this change on a week-to-week basis, because at least for the indexed hedge trades that I do on a weekly basis, right? So I had November 4th positions, then now I have some November 11th position, November 18th position. But that's what it's still a positive drift. The overall delta is not negative, still a positive drift on the overall portfolio. I hope that answers the question. All right. Long portfolio means any stock buys or sells. I bought TTD a little bit, added to my portfolio for last week. Again, they are going to report earnings, I think, next week. And this is not for earnings movement. I wanted to buy more for it and, add this to my portfolio. I already hold some. I do want to increase the position in it. So, yeah, I think there was one day when the markets were down. And that is why I spoke on earlier also. I want to train myself to to buy when the market is down and refrain when the market is up. So when the markets had gone down, I was looking at, okay, which stock did I have on my watch list and I want to buy without adding additional ticker right now. And then I realized the TTD was one which I wanted to buy. I'm like, okay, today TTD is down 5%. So let me dip into it. So that was my only long stock purchase for the last week.
What is your criteria for getting more? I mean, how do you?
I like TTD business, and we'll look at the next. We will look at the result. So I like what Trade Desk is, the spot it is in. It is the biggest player on the, for their sell side platform. I mean, it is beaten up because of the advertising, but I think I do want to buy and accumulate it for my long-term growth.
But how do you know it's not going to go down more? Like, why don't you buy Google?
Google, because I already have, look at my, Google is already sitting in my top 10. So I have Google right now. I also have a strangle on Google, which is now right now underwater, means if it stays here, I will buy a little bit Google more. I have a short put and a short call on Google. I have a strangle on Google position already. So I know if Google doesn't recover, I will end up picking up some shares of Google. So that is why I did want to increase the TTD because I hold in my portfolio, but I do want to buy more of it because I like this company. Will it go down next month, next year? Absolutely. Who knows what could happen? But I think overall, the changes that they're doing on their platform, there's something called Open Path, where they're also now starting to get onto the buy side of the platform, right, and not just the sell side. So they're gonna want to become and own the DSP as well as the SSP, demand side as well as the sell side on advertising tech. TTD P crush is still to come, possible. I mean, it's not a, when you're looking at a valuation, Chintan, it's not a cheap company yet, right? And sure, after, let's say, announcing a result, the way we're looking at many of the advertising companies, the results have been bad. Stocks have gone down. If it goes down, maybe I'll pick a little bit more, right? And then I'll basically, sell covered calls to reduce the cost basis. Right? So till now, I mean, I only started building positions in TTD this year. So I bought it, and the stocks that I hold is an average price of $51. And I think I started buying it like 3 months ago. And so far, I've reduced my cost basis by $2, which is 4%. Right? Over a year, selling premium, I think I could reduce the cost basis of the stocks that I hold by between 10 to 15%. Right? So if you continuously do it for 3, 4, 5 years, I mean, you own the stock at half the cost. So that is why I don't want to sit and time the market. I used to do it before I started learning options, because then I was only dependent on the stock market movement. But nowadays, I don't know. If it goes further down, I'll pick a little bit more. Right? I'm not, allocated or bought the full, whatever the allocation I wanted for TTD. I haven't put full money on it. Right? Buying 1/5. So yeah, so that's why I picked TTD. I think last week I shared a few other stocks that I picked. Because those stocks went down, I'm like, yeah, I think I do want to hold in my portfolio. I have a cash, and that's why I hold cash, that if there are opportunities that present themselves, I'll pick it. No one can time the bottom. No one can buy, the everything at the bottom, and so I will buy it when I think, okay, I think the stock has gone down. I want to accumulate it. Could be short-term, headwind. The market is looking at what is going to do in the next quarter. I'm not looking at for next quarter, for next year. Okay. There are hardly any stocks that I sold this, except a few where I wanted to do a tax loss harvesting, or move or buy another ETF equivalent of it, because I was focused on reducing the number of tickers that I hold in my portfolio. Other than that, I just reduce my cost basis. All right. Yes, it has earnings next week, and I'll be watching what TTD has to say. So that we talked about Google. There is Google here. Someone tweeted on Google was $75 before COVID, 161 billion revenue, 34 billion net income, 13.97 billion shares. Now it is 85, $285 billion revenue, 66 billion net income, and 13 billion shares. So shares have reduced. Everything else has gone up, with the stock price is closer to, not proportionately, it's still lower. So yeah, so Google, your question, why not buying Google? Because I already bought Google this year, and I already have a bullish trade on Google. Can we talk about tax loss harvesting? What is the limit? So to be very brief, there is no limit on tax loss harvesting as long as you can offset it against the gains that you have made somewhere else. Right? So if you have a gains, if you have sold something and you got a gains on that, then you can sell some stocks and negate and balance it with the gains. If not, you can only carry forward, I think it's $3,500. It's either $3,000 or $3,500. I'm not a CPA, so keep me honest, but it's not too much. So right now, because I had some additional income. So from my stock side, I want to make sure that I do some tax loss harvesting. Right now I'm on a little bit positive. So I'm looking at a few more shares which I can sell. Okay, it's only 3K. Right? It's only 3K is what you can claim as a tax loss. Everything else will be carried forward to the next year. All right, another chart which is not good. If you're thinking that the inflation will go down, which is around supply chain, diesel supply is the worst since 2008. So the supplies is failing to catch up with rising demand from trucking, farming, heating. So something to keep an eye on is the diesel, which moves our goods, which moves all the trucks, which moves the locomotives. Its supply is a little bit constrained and is the worst since 2008. So if the fuel cost continues to rise, and I hope it doesn't become so bad that the goods, it completely halts the movement. But I guess the price says that the retailers will have to pay to move the goods will become higher, and then it'll not gonna be good for inflation. Right? What else? Yeah, this one again, interesting one is comparison of different charts of S&P 500, GDP, payrolls, and earnings. Right? And which bottom when and which peak when. So this is 1957 Eisenhower recession. So S&P 500 bottomed here. Earnings bottomed 12 months later. Right? GDP bottomed maybe 6 months later. So markets kind of a front run the recession or the earnings. Same case, this is what stagflation era. Right? Earnings bottom here in December 75, market bottom in December 74. 1980s double dip recession. What's a double dip? So S&P 500 bottomed in, let's say it is 82 to 83, let's say June 82. Earnings bottomed at June 83. GDP bottom, oh, this was a double dip. GDP bottomed in December. Same is the case here. Savings and loan crisis 1990s, S&P bottomed here, earnings bottomed here. Global financial crisis 2007, S&P bottomed here, earnings bottomed almost 6 months later. COVID, S&P bottomed here, earnings bottomed 6 months later. So while we are seeing the earnings compression is yet to come, yeah, but that's not a secret anymore. Again, I don't know. Maybe we will see the similar trend that S&P will bottom before the earnings bottom. So if we are waiting to see, oh, I think I will get into the markets when the earnings have started to go down. Maybe looking at these charts of all 6 recessions, S&P actually bottoms, so markets bottom sooner. They front run the earnings bottom, bottoming of the earnings. Right? So who knows? But this was an interesting one to see. And yeah, I'll see if, what happens in the next one. Is this recession going to be any different when looking at the relative movement of the earnings as well as S&P? All right, another interesting one, and we talked about metaverse and what Meta is doing, but what I did not do, and this does give us some idea about how much money Zuck is investing in metaverse for good or bad reasons, right? We're not going to talk about the reasons, whether it's good or bad. We debated it last session, but the amount of money that Zuck is planning to spend over last decade is the same amount of money that was spent, and this is inflation adjusted, in Apollo program. Okay. If you compare it with others, Apple first iPhone was 3.6 billion. Right? Manhattan Project was 23 billion. Even Tesla was only 25 billion. And all the bets for the Google, those are moonshot bets, is only 40 billion. So this metaverse bet is really, really huge bet. If it doesn't work out, it's going to wipe out. Either it's work out or it's wipe out. So, and I think there's another chart around the same thing about Meta. Share price and the market capitalization. Right now, the stock is lower. I think this was like last week, Thursday. Probably it's gone down further, but it gave up all the gains of last 66 years. It's back to end of 2015. So yeah, is that the time has turned back. You can buy if you are interested, and if you have faith in metaverse, then you can buy Meta at the prices that it was available way back in 2016. Has Zuck Meta publicly disclosed spending 25 billion next 10 years? No. So I think there was, again, this was done by, let's say, combining some of the comments that Zuck had given in various forums. So one thing that we know for sure is he's told that he's going to spend 10 billion this year. And I think in another conference or somewhere in review, he also mentioned he's going to increase the spending year over year for the next 10 years. And now if we look at, I think he's increased by 40% or something. So this is not a publicly number. This is a derived number based, based on some of the comments that Zuck had given and how well the analysts have understood it, right? But so don't take it as a completely 250 face value, but the idea is the spend is huge. By whichever way you look at, it's a huge spend, a huge bet on metaverse, right? Even if this 250 is 150, still it's a huge bet. So the company has moved from $1 trillion to now, what is it right now? Meta, let's say, META, Meta Platforms. Yeah, oh, okay, 250, so not that old. Yeah, lost 75% of its market value from the peak. But Zuck ain't stopping. He ain't stopping. Another chart, it was a gold. I know there were some comments about this is a manipulated market. Gold is manipulated. Maybe, where are we? I don't know. Now it is like back to where it was around 2010. So all down, went up as a come back down. And it has the longest monthly losing streak since 1968. I think it's referring to this down in a month. I'm not happy with it because, as you had seen, gold is on one of my top 10 holdings. But it is, the SP says time to go long. I'm already long on it. All I'm doing is reduce my cost basis on gold. So I think right now I have 2 covered calls on gold already in place. All right, other one, recession. We are talking about recession. And in October, Dow had its best 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th, best 10th October month in last 100 years. So what recession? Everything, so there's so many of the conflicting signals, right? Dow posted its best monthly returns. Another interesting one, this is where, the oligopoly in the hyperscaler market. Q3 2022 market share, Amazon is now 34%, 21%, 11%. That makes it 34 and 45, 66%. 66% of the market is controlled by 3 entities. And then the 20 companies control the rest of the 25%. So huge oligopoly. I do want to say, I think maybe we will see Oracle and IBM coming up over here. Start to show up as a separate one, but right now their share is so low that these 3 own the biggest share. And that is why, I do want to continuously hold these companies in my portfolio, except Amazon, Microsoft, Google are huge cash generator. Amazon consume cash because we know the right reasons. And I think now they also announced getting into sports commentary. I don't know if you heard that. Amazon wants to get into sports commentary. They'll be running 24/7 commentary. And they also announced hiking the Amazon Prime fee. And I think they also added more benefits to Amazon Prime. There are still, I don't even use everything that is available to me. What I heard was under the Amazon Music library, they added more, they brought in more albums. I think it's supposed to hike, say,
Vivek,
139. So they're going to increase this. Yeah.
I belong to Amazon Prime for only 1 month. That's actually all you need. All you need is 1 month. And I enjoy the videos. The thing about it is they send stuff so quickly. I don't even belong to Prime any longer, and they send it like it's ridiculous how fast they send it.
Yeah, probably whenever kids, I get to know, Dad, I need this like tomorrow. So I still need Prime. I don't think I can get away with Prime. I will still pay for the increase in price because I think we're kind of addicted to Prime. At least my family is, and I know millions of others are. So SP Music is included in Prime. Yes, it is. And they recently announced a hike in the Prime and also added more albums under the music, giving more benefits to Prime customers.
What I'm saying, Vivek, is the deliveries is so fast. It's ridiculous. That the only reason I joined Prime last was so I could get into that their Prime sale. Remember during summer?
Yeah.
And but the deliveries, back like a decade ago, it used to take like 3 weeks for delivery.
Yeah, so it's all relative, right? And next week there is another company that is announcing results. Now you compare Amazon to that company, Amazon is slow. So I understand. I think Amazon is too fast, but today's generation wants things in a couple of hours. So I think there are companies that are working towards that, right? So I see another question. How low will Google go? I have no idea. I don't think anyone has an idea. And again, it looks at what time frame you're looking at. I'm not a technical chartist to give any estimate on how long will Google go and in what time frame. But for me, I think Google is at a point where they have so much of a compression in their PE, GOGL, that I find this attractive. Anything below 90 for me is an attractive price to own Google. What's the PE right now? Google, GOOGL. 17. And this is a company which gushes cash, have great balance sheet, good free cash flow, and right now it's at 17. Could we go further down? Yeah, on an average, S&P's average PE stays around between 13 to 16, but this is grows at much faster than S&P, right? So why is Google going down? Because of the tailwinds in the advertising sector. Search advertising is the biggest revenue generator for Google. And we all know right now, when the recession comes, first thing corporates cut is advertising. We have seen what happened to Meta. We have seen what happened to Snap. We have seen what happened to Google. So that's why it is going down. It has gone down. Once this macro becomes better, as a business wise, how they operate the business, I don't see any issue in Google. Right? But you can't fight the macro. Fed chart, mortgage average rate has inched above 7%. So if you were qualified for $1 million home at the start of a year, right now it's around 600K is all you can afford with the same, for the same outgo of your monthly payment. So bad from a housing perspective. Mortgage rates are still continuing to stay high. This is the Fed balance sheet. It has come down from near 9 trillion to slightly less than 9 trillion, but a lot of fluff yet to be given up. If we have to unwind this, and this is why they say we still have to see a lot more downward movement in S&P, because they have to unwind this, we'll have to suck the liquidity out of market. And it's an interesting, how does Fed actions, when we say Fed is printing money, what do we exactly mean? Maybe I'll cover that in our next session, but it was an interesting read. I did a long read. It was, I think, last Sunday or Monday, Tuesday. I had to drop my kiddo to a place and I had a couple of hours and I was trying to read through understand this whole money printing, how it happens, how does this whole government, Fed, and our commercial banks are involved. And it opened my eyes on why the banking structure, they just make money by doing nothing. Really. I'll talk about next week, and it's all perfectly legal. It's the government that does the work. It's the Fed that does the work. And it's let's say Bank of America or JP Morgan, they just get paid for doing nothing. So that was an eye opener for me in terms of how the reserve ratio and the Fed payments to the banks. I'm like, wow, that's cool. You don't have to do anything. It's the taxpayers' money or the government which is doing, and you still get paid. That's why the banking has become so integrated with our overall financial system. But maybe we'll look at that, how the money moves, what do we mean by bank printing money, and now how the Fed funds increase in the Fed funds rate, will it reduce the money supply and hence kill the demand and hence will reduce the inflation. Let's say topic for the next week. I'll skip this. I want to go towards earnings, but before that, if you missed, if some of you, if you are new, maybe, I don't know, I think last week I saw some new name, but if any one of you are new or maybe a refresher, if you missed these sessions, you can go to the website, my website, optiongeek.com, and under members, click weekly webinars. Now this is open for all, so there's no charge. You will be able to access the recording of the previous webinars. So I know 148, I forgot to hit the record button, so I don't have that. But yeah, last week recording is up, so you should be able to go and if you want to review something, if you want to review T-bills and the notes and the bonds that we discussed in session 146, it is up there. We talked about I-bonds and how to buy it, what to buy, T-bills, building ladder on T-bills. By the way, my first ladder will be maturing in around 11:15. So, maybe not next week, but a week after that. All right, I'll sip some water, and now we'll spend some time on earnings. Hopefully we can wrap up not too late. My apologies. Last week we went over almost an hour. Don't want to do that this week. Any other questions? Any thoughts? All right, T-bills, remind me. Anyone? I know last week someone told you bought some I-bonds. Did anyone of you dip feet into T-bills? No T-bills? Okay, I see one. Yes. But I was surprised. I'm like, why didn't I not look at T-bills earlier? Because it gives the combination, right? It gives a combination of decent return and the liquidity. Right? I don't have a 4-week CDs, right? But yeah, I could have a 4-week T-bills. So which will make sure that I do have a liquidity opening up after every 4 weeks, while the money is not sitting in my savings account and earning nothing. So that's why some of the money in my bank savings account, I moved to T-bills. So that's the cash portion which is represented. All right. So I do want to structure some of the T-bills in a way in which it could be every 2 weeks. Right now, my ladder is every 4 weeks is when they're maturing. Maybe I'll cut down the amount into half and structure it so that every 2 weeks I can decide, I still want to hold cash or do I want to invest? All right, let's jump into earnings. Yeah, anything else before we dive into earnings? It's almost 11:40, so we have 20 minutes. I think I'll probably need maybe 50 minutes, but we'll see. I'll try to wrap up in next 20 minutes. All right, let's jump into earnings. Mercado Libre. Mercado Libre, if you don't know, is Amazon, PayPal, eBay of all combined together, plus Venmo, plus Square, all combined together operate mostly in Latin America. As you had seen earlier, this is one of my top 10 holdings in my portfolio from business perspective. Let's look at their performance. They have multiple businesses. One is Amazon business, which is nothing but operating e-commerce, which is known by Mercado Libre, the flagship, the company name. That was up, revenue was up $8.6 billion, 32% up year over year, Forex neutral year over year. Sorry, this is not revenue, but this is a gross merchandise volume. So this is the amount of goods that are the value of the goods that move to Mercado Libre online e-commerce website is up 32%. Net revenue is up 61%. Revenue is $2.7 billion. So it's not as big as, let's say, Alibaba's or the JD.coms or the Amazons of the world. So it is still, I would say, a mid-cap company. Look at that. It's less than $50 billion a company. But yeah, the revenues was up 61%. The other business which they have, which I am a lot more bullish on from a tailwinds perspective, is their Mercado Pago, which is a payment. So we're looking at a payment in terms of total payment volume. It was up 76%, which is a great growth. Total payment volume of marketplace means the amount of a payment, and this is where the Square part comes in, right? Is the amount of a payments that is being running through the Mercado Pago system, but spent is not happening on MercadoLibre.com. It's an off marketplace. So Mercado Libre is a marketplace, just like Amazon.com is, but their product, and that's why I say it's also Square, because they have a point of sale terminal which any other retailer can use, right? And it is good to see a lot of a growth in that particular segment. It means they're not dependent just on how their own e-commerce is running. This is similar to, say, like a Square, dongles are used across every other businesses. So this is their total payment volume of marketplace, healthy growth on more than 100%. Next one want to see is Mercado Envios, which is their logistics network, right? Just like Amazon does fulfillment by Amazon. So they do have a logistics network in which other merchants who are not on their marketplace can also make use of their logistics services, which the overall goods moving was up almost 90%. Credit portfolio is their financial, I would say, there's no equivalent, right? This is, PayPal doesn't do it. It's like not broker, but it provides a credit. It's like maybe part of a Square, because Square does have a merchant credit solutions. So they do provide loans, etc., to merchants, which is they're represented in the green. I don't know, both are green, different shade of green. That was up 146% year over year. So overall GMV 32, which each of the largest market, they saw good growth in GMV. Unique buyers is now 43 million, which is the highest in the Melly's history, with a growth of 10 year on year. 55% of deliveries were made same day or the next day. And almost 80% of the deliveries were made within 48 hours in Mexico and Chile. And that was the biggest year over year gain in these two countries. So Sam, you were saying it is Amazon delivers fast. Now here more than 50% is on the same day and the next day. Digital account total payment volume, P2P transfer, that's what I was referring to as a Venmo kind of a stuff, PayPal, Venmo kind of a stuff. That was up growth of 138%. We processed more than 14 billion transactions, growth rate of 66%. Oh, this is little I chart, but I like it. I've been reviewing the results of Mercado almost every quarter. This is the first time, at least I remember, that they actually put all the metrics in just one slide. Why don't all companies do it? It becomes so easier as an investor for me to now get all the information, all the KPIs, all the metrics that I want to look at the business, all in one slide. Right? You want to focus on the marketplace, or these yellow ones is what I should look at. Right now, oh, they got a Brazil, it was up 15%. Now, okay, this is their country-wise, this is their P&L, this is the number of users, and this is the total volumes. I like this. I wish every company provides investor with this slide. They have all the data. Why don't they help us? But yeah. So overall, what do I see? Like I said, I've been tracking this for many quarters. So mine still stands. I'm still bullish on it. Business-wise, everything looks good. I will buy more if it goes down below 800 because it's already of my top 10. And if not, I'll continue to sell unbalanced iron condor for premium harvesting. So far this year, we reduced the cost basis by $100 on this particular stock. I can't time the bottom. So I want to focus on, continuously reduce the cost basis. Right now, my cost basis is close to $1,145. This stock was somewhere $2,000 last year. Okay. So yeah, probably another 2 months to go in this year. I will pick up another, $10 reduce, $10, $15 reduction in cost basis. But I do want to hold it. Yeah, this is a one position that I still have open on this. Right, it goes below, it's okay, below 900. My risk on the option trade is very limited. I'll probably pick up some stock if it goes here. But if it goes out on the right side of my iron condor, the rest of the portfolio will benefit. I'll sell more call on it. Stays between 890 and 1010. Gonna make close to $1,100, which will further reduce the cost basis. I'll probably close this trade when it's making $600, $700. Right. So it is November expiration. So 2 more weeks to go. So, and this is what I think someone asked, how do you protect? I'm focused on reducing the cost basis. Right. So this is I already gained 10% this year. Right. On, let's say $1,100, I saved $100. I saved 9% reduction. Right. So we'll do it 3-4 years. And if you do it more, there is no reason that you cannot, reduce a cost basis to 0. I do have some stocks where I made more money in selling premium than what I bought these stocks for. So my cost basis is actually negative. So any return on that is kind of an infinite return. There are only, I think, 3 or 4 stocks that I own. My intent is to make everyone as a negative cost basis. Anyway, any questions on Mercado Libre? I didn't see anything which is concerning so far. So I'll still stay bullish on this. Moving to the next one, which is Uber. Good, healthy gross booking was 26%. Operating, okay, so this is a few things that we should look at is, so now okay, let me go take a step back. So Uber has got 3 businesses. One is mobility, which is what they are most known for, ride hailing. Second is their Uber Eats, which is what they built and grew, not built, but grew during the pandemic. Now Uber Eats is almost equivalent of, of their mobility business. The third one, which is growing business, is Uber Logistics, in which they tie up with, they move the goods for big retailers or factories, etc. So these are the 3 main businesses of Uber. So when you talk about mobility gross booking, this is moving people. Adjusted EBITDA and EBITDA margins are all-time quarterly highs. So for almost a year, market has changed its expectations on Uber. They want Uber to be profitable. So we are seeing more and more focus coming from Uber management to talk more about how and where they are in terms of profitability. Uber has been around for now 10 years. It hasn't made a dime so far. When it comes to profit, indeed, it's been losing billions and billions of dollars. Given the tough market condition now we have, investors don't have that patience. They do want to know, when are you going to actually make money? Growth is great. Right now, the environment is, we want to see cash flows, we want to see growth. So good to see a commentary from Dara saying the adjusted EBITDA was all-time high. Operating cash flow, a free cash flow of 358 million. So at least they're now focused on generating free cash flow. This is what FCF is, what market wants to hear. Revenue grew 72% year over year to $8.3 billion. Right. And what else? Strong demand for our offerings, better marketplace efficiency, and our asset-light platform helped us to deliver adjusted EBITDA well above our guidance. So no surprise, market actually loved what they saw in Uber, and I think the stock was up like 18, 20%. Was that?
Vivek.
It was up a lot, but I think after that, during the day, eventually it closed the day with still up 12%. Yeah, Sam, you had some question?
Another person is interested in ETFs. If I had invested in ETFs in 2013, just, I guess, whatever, SOX, I would be very wealthy. But can you talk about ETFs and how to select them and what industries? Thanks.
All right. Yeah. So maybe not today. So let me take a note of. If you're interested in talking about ETFs, we will. And this is how everyone as a retail investor should start their journey. When I started my journey, and I think I've spoken multiple times on this, I started my journey with 7 ETFs because I did not have no time to look at individual stocks. I wasn't even interested in looking at individual stocks. I thought stock market was a gamble, which is how most of it is presented to us. Oh, it's a gamble. You should stay away from it. So I wanted to get in. I started my journey with focus only on 7 ETFs. Slowly, I became more comfortable with the market and started analyzing individual companies. That's where I started to pick up individual companies. So yeah, I can spend some time on ETFs and maybe pick up a diversified set of ETFs. In fact, this week we were having a dinner conversation. We had an office dinner. We had some sales QBR and we had folks coming from different places. So we were in one of our senior VP. We were talking about even like market is gamble. And there's another person who is a little young investor. And he was like, oh, no, he said like, no, if you think it's gamble, just pick S&P 500. Just pick an ETF. And nowadays, there are so many options available at such a lower cost, almost nothing, that if you don't understand individual companies, we shouldn't be in individual companies. ETFs is the way to go. All right, so we will touch base upon ETFs next week. However, I mean, I've spoken about many different types of ETFs during this week, right? You think of your investment, what you want to do, you will find an ETF for it. If you're interested in a copper, you'll find an ETF for it. If you're interested in commodities, you'll find an ETF for it. If you're interested in farmland, we looked at some farmland ETF. We looked at the ETF for water. Every type of ETFs are available. So, okay. So we'll talk next week on ETFs. I see a question from us. Are you following Dash 2? No, I'm not. So the only stock that I'm interested in, the reason why I'm not following Dash is they are only on the delivery side. When I say delivery, means delivery of not people, but delivery of food, delivery of goods, from retailers, etc. The reason why I'm not in Lyft also is they all have only one vertical. So the reason I'm in Uber and I'm an Uber shareholder is because it got multiple businesses, right? And that's why I'm not following Dash. Delivery is a very tough business assets to make money. It's not an easy business to make money. So I do want to look at, if I were to pick up an individual company, I don't know if there may be an ETF for all these, who knows? But the reason why I'm not on Dash is because it's got only one business segment. And also, if you can correct me if they ventured into more. But last when I looked at it, they were only into delivering food. Probably they have expanded to delivering other stuff also. I don't know. But like Dash is there, Instacart is there, Postmates, anyway, Google bought it. Not Google, Uber bought it. So no, I'm not following Dash. So I am, that's why I'm following only Uber from that genre of delivery companies, because Uber delivers people, Uber deliver goods, and then next one they have is their freight business. So does give them a more diversified business streams. Okay, yeah, mobility grew 73%, delivery grew 24%, freight almost not a significant change. All right, so let's look at what's more interesting is the take rates. Great, you grew your your gross volume, but what's your take rate? Right? This is a very encouraging that the take rate is grown up by from 22 to 28%. On delivery side, it's grown up to almost 20%. And so overall, the take rate has increased almost by 1/3. Right? So almost by 1/3. So take rate is, well, if you're not familiar with the definition of take rate is how much does, Uber makes money. If you are paying, let's say, $50 for your trip, and of that $50, if Uber's share is $5, then their take rate is 5 divided by 50, which is 10%. So while the overall, the volume or the value of the goods or the services provided has increased, but if the take rate doesn't increase, then it means there is no leverage. Right? So if you are able to extract some leverage, then you're able to, for the same amount of GMV, you are able to increase the revenue because the take rate has increased. So I was happy to see this take rate, higher take rate. Outlook, gross bookings to grow 23 to 27%, and an expected 7 percentage point of year-on-year currency headwind. So that's being considered, translating to $30 to $31 billion of gross bookings for next year. For next quarter. That's just the bookings, right? Not the revenue. So the revenue will be dependent on how much take rate are they able to get in the next quarter. So if your take rate is 30%, then your revenue will be 1/3 of it. Say question, is it too late to get into energy or XLE? XLE has a nice run, but over the past few weeks, so there may be some profit taking here. And let me put something, right? So if you look at, if I'm looking at right now, it's touching on the top of the Bollinger Band. If you are a Bollinger Band a follower, if you are follower on moving, there's another one which I look at is options going short. So if you there is another combination which generally, I don't know, I used to look at it, no longer, but nowadays. But if I look at this, right now it is on, does shows that it is in an overbought condition. So which is a CCI, RSI, and stochastic. And these three all are up. When is it at this RSI is also up here, where is this, as well as all three. We do see it might decline sometimes. So short term, maybe. But I think from and there is a lot of political narrative which is going against these companies. So next quarter, it may be difficult for the companies to do a quarter-on-quarter comparison. But I think crude oil at, where is crude oil at? Is at 90 right now? Yeah, it's 90, right? China opens up. China starts to fully open its economy. I think it might could still go higher. But short term, the tech indicators do tell us that, again, they don't tell anything. So please, please, please don't consider that we can make a definitive assessment on that. But if you were to look at the tech side, at least some of the indicators that I had followed in past, they do show that this is over, it's on a higher side, should see some weakness. So I do have a strangle on XLE. I hold some shares. I have a strangle on XLE with the short, it's a covered call. So with the $90 is where my short call is of the strangle position. So I'm still holding to that. Assuming if we see some short-term weakness, I can close that strangle for profit. And if you go further down, I do want to buy a little more of it. So I think my short put, it was 7. I started with a 70-90 strangle. I rolled it up to, I think it's 80. Yeah, now it is 80-90 strangle. And so yeah, if it comes back in here, we'll close strangle for profit. Otherwise, the stock will make money, if not the option. Oops. There we go. Is XLV somewhat recession proof? Yes, it is. Healthcare companies generally, when the markets are bad, you will see healthcare companies doing good. You'll see consumer staples doing good, because we have to eat and we have to go to doctors. We have to take our medicines, we'll have to eat. So healthcare is generally stable and does better than the other sectors in a recession. And I think XLV probably has done better, is doing good this year. It can decline if you look at the year-to-year basis. XLV is done way better than S&P 500. It's down only 2.3%. It has done 20% better than the rest of the market, because S&P is down almost 22%. So yeah, this healthcare is considered a defensive sector. Consumer staples is considered defensive sector. Utilities were also considered as a defensive sector, but with the interest rates going higher, I'm a little concerned about utilities, because generally they have a debt on their books, and if interest rate continue to go higher and they need to rotate their debt, then gets into little precarious position. But if normal circumstances, not when the Fed is increasing the interest rate, utilities is also considered as a safe play, because we will need food, we will need electricity, we will need water. So yeah, utilities, yeah, we will eat food, we will wear clothes. Consumer staples is needed. So is the medicines, so is the doctors. Okay. I say common being following Uber since IPO, high level gig economy should be profitable, taking a cut without having to increase skill. Airbnb, why do you think Uber cost of operation is so high? Just the transport bit doesn't have enough margin to be skimmed. So Uber, I mean, the Uber had to give a lot of incentive schemes to attract the drivers, right? And now we have seen also in some other countries where the drivers have, and their cost of operation is high because you have to build your network really big, right? So they had to give lots of incentives to drivers. Now they are cutting back on incentives because now I think the market is also improving with the fact that some of they were able, I think in this earnings call, they say that they were able to attract an onboard drivers much better without giving they didn't have too much of a difficulty in getting new drivers on board. So building up this network it will be costly, and I think we are seeing in terms of Uber from a margin perspective, I think it's going to be a thin margin game. It's not going to be a huge margins. Probably it's going to be more of a volume game than a margin game. That's my thought. But the reason I'm still on Uber is it also passed my snap your finger test. So snap my finger and say Uber disappear from this face of earth. Will I miss it? Of course. Will the world miss it? I think. So this is a company that has now become important to us. Probably, 5 years, 6 years earlier could happen. But right now, it is become important that this business, I think, will be there for longer. Now, making money out of this business is a little tough because it's not a high margin business. So that's why I like it that they have optionalities of the freight and the other stuff. Essentially, commodity biz disguised as a tech, given they're out of robo-taxis. They spun out robo-taxi because that was, again, more focused on getting the moving to the more profitable side of the house. So they had to spun it out because that was a cash guzzler, and all the cost of that Uber robo-taxi was showing up on the Uber books. I don't know. I think they sold it to what? Aurora Innovation? Do they hold? Maybe they do hold some stake in Aurora. But at least Uber stake. %26. Yeah, so they do hold a stake of 26%. So they sold it to Aurora. Get that big expense off your books. That's why I'm not in Dash, I'm not in Lyft, because this is a tough business to make money, right? But yeah, we'll miss this business if it goes away from the face of earth. So that's why I do want to invest in it, stay invested on this one. All right, next one is Airbnb. Almost 100 million nights and experience booked. Gross booking value. Again, the Airbnb is similar concept like Uber, where they have a bookings, then you have your own revenue. So bookings means the amount that you and I pay on the Airbnb website to book a house, and the revenue is what goes to company, because the rest of them goes to host also. So the revenue is close to $3 billion, but bookings was $15.6 billion, up 31%. Net income, they actually made money. It was the most profitable quarter ever with 1.2 billion, and it was up 46% year over year. Right? And adjusted EBITDA, I'll skip adjusted EBITDA because now actually we have a net income. Free cash flow, almost $1 billion of free cash flow. So we're looking at many of these companies whom nobody would have asked for net profits or free cash flow 2 years ago. is now everybody's starting to focus on free cash flow and becoming profitable because the macro has changed. Investors want them to generate cash. Because if you don't have cash, you might have a net profit, but if you don't have cash, the company could go bankrupt. Right? You can't, pay your suppliers in depreciation, because you can increase your profit by taking high depreciation, but you can't pay your suppliers in depreciation. You have to pay them in cash. So companies are focused on conserving more and more cash. Management commentary, Q3 was the biggest and the most profitable quarter ever. Right? We looked at 100 million nights and experiences. We looked at this. Also had a biggest and most profitable quarter with $1.2 billion of net income, which is 42% net income margin. Free cash flow over the last 12 months is now $3.3 billion. So that gives them optionality. Right? So Q3 result demonstrates the Airbnb continues to drive growth and profitability at scale. Now remember, this is the company, and I think in the books of in the management books, it will become a case study of how a company emerged from a brink of being extinct and came to a level where they're generating $3 billion of a cash flow in just 2 years, 2.5 years. During COVID, their revenue was zero. And no one was traveling during the initial days of COVID. And I specifically remember Airbnb wanted to go IPO at that point of a time. And when the COVID struck, everything went down. Travels were all suspended. No one was traveling. They had almost zero revenue. You can't go IPO at that level. And they needed money. And they raised, I don't know how many $1 billion. I forgot that. But we did talk about it. And they raised, but what I still remember 2 years ago, they raised at an exorbitant price of close to 10 or 11%. They raised debt because no one was willing to give them any money because it's a dead business, such a risky business, Airbnb. And at a point of a time where the Fed fund rates were almost zero, money was freely available. Fed fund rates were zero, but Airbnb had to raise money, debt money at a rate of 10% or 11%. Because no one thought that this company has any chance to come out of it COVID and survive COVID. And then they came back in 2021, did IPO, and now back onto the profitability. So I think we should look at in terms of also how management behaved. The management also had, they had to let go some people. But if I remember correctly, and someone please correct me, but I thought, was it this company or some other? But when they let go people, they let them keep their laptops. Was it Airbnb? Airbnb, we lay off 2020 laptop. Let's see. No, Airbnb creates a new listing. They created a new listing. So they handled it really well. Maybe it was another company. We actually let employees keep the laptop, but Brian Chesky handled that situation really well. But come on. General severance package. Yeah. So again, but this company is back with the bank and is growing nicely with profitable. So overall, all good, right? Guidance was, they gave a guidance of 1.8 to 1.88 billion in Q4 means year-over growth will be 17%. A year-over growth of between 17% and 23%. Okay, this is year-over growth as compared to last year is 17% and 23%. Okay. Now, this quarter you have grown almost 46%. They grew your revenue 46%. Was this for revenue? Yeah. And now you're saying the next quarter as compared to the previous quarter, 2020 will grow only 17%. Oh, markets didn't like it. So if you look at Airbnb, disclaimer, I am shareholder of Airbnb. Market didn't like it. And market looking at it the next quarter. You know, your growth is slowing down. You're going to grow only between 17 and 23%. So market punished the stock. I think anyone who understands the business and you know, think that the business is a long-term good, I think this was an opportunity. Okay, not a financial advice, but you need to know what Airbnb does, how its business is. So far, I think it's all good from business perspective. But market punished the shares because, I don't know, it's only 17% and 23% growth. Right. But remember this 17% and 23%, and that's why they gave another comparison of Q4 2019. So last year, 17, when the markets, not the markets, when the travel opened up, people started to move again. Airbnb saw a lot of tailwinds because, oh, I don't want to go to hotel because I love other people around me in the hotel. Hotel are a closed spaces, right? So when the people started to move after the initial shutdown, you know, world economy shutdown in COVID, Airbnb enjoyed a lot of tailwinds because they gained a lot more businesses from the hotels, right? I mean, our family, we were like, if you're going out, we're not going to stay in hotel. We need to look at an Airbnb. And I talked about it that I'm not even getting it so super expensive. If you can find a Airbnb home. So that growth, they enjoyed a tremendous growth in the Q4 quarter of last year. If you are comparing with that number, this Q4 growth will be between this, right? So, but if you go to 2019, they're going to increase like up to 70% higher than what they did 3 years ago. Okay. So anyway, net, short term, oh, your growth is, you're not growing as strong and the stock got punished. But I think from my perspective, it's still up. So this is a stock that I added in 2022. You know, that's the beauty of keeping some of the cash available. I started adding to this position, you know, somewhere in 2022, and I do hold. Now this is one of my top 10 in my portfolio. Next one is, I think this is the last one, Block, and then we'll be done. Yeah. Last is the Block, formerly known as Square. But now it is not just Square because this company has moved into a lot of other businesses. There's into Tidal, they are into Cash App, they're into Square, of course. So let's quickly look at this. Excuse me, let me sip some water. So they have a consumer business, which is Cash App, right? In which you can do a payment transfers. It's also this more focused on the consumers. You can buy stocks, you can buy Bitcoins if you want to. So and they have a Cash App card, which is your like kind of a credit card. So they saw Cash App activities more than 40% year over year. What the Square started with and what it is known for is the namesake, their hardware stuff in the app, which is Square app, which is focused on merchants. Starts with your point of sale solution, you know, those dongles that you go to farmers market and those white square dongles. in which they'll take and swipe your card is come from Square. I think they're now more than the dongles. Probably but those are a point of sale solution. That's how they started. That's how everyone knows it. But then they started adding more and more features, right? For merchants to track it. Now the merchants can manage the payroll. Merchants can do all the invoicing, payroll, inventory management. Now they have started to create industry-specific solution. Square for restaurants, Square for retail, and Square appointments. Well, I don't know what's the Square appointments, but this is how, I mean, what I like about this company is start with one and then, start growing the rest of the businesses. So, but all this, Square business grew 45% year over year. Gross profit was up 38%. And Cash App generated gross profit of 774 million. And the Square generated profit of 783. So these are the two big ones, merchant solution and a consumer solution. Both are kind of contributing almost equal to the gross profits. So let's look at their balance sheet, transaction-based revenue, subscription revenue, hardware revenue, Bitcoin revenue, 1.762. So the and the net loss is very less, only $14 million. Right. And non-Bitcoin revenue, because Bitcoin revenue can be very, very volatile. We have seen it in Robinhood case. We have seen it earlier in a Square case as well. Is it depends on the crypto market, if it's whether it's summer or whether it's a winter. So we do want to look at the more less volatile business, which is the other stuff. But it's good to see that even the non-Bitcoin revenue was up 36%, and the loss was very moderate, 14.7 million only. So yeah, I'll still be on Square. I still like it, but I had one concern. I don't see it here. The only thing that I didn't like with the Square was that they bought Afterpay. And I am so far not too big on this whole BNPL stuff. Maybe it is because, this is like different generation stuff, maybe generation gap, but I am not the one. I don't have a positive vibes for buy now, pay later. So, but Square bought Afterpay, and they had to pay through, they paid a huge amount. I think mostly it was stock, but still they paid a huge amount to acquire that. That's one concern I have on Square. Otherwise, I think this, again, one of our businesses that is helping the businesses and the consumers to move payments and the money faster. The use of cash is going down, will continue to go down. So I think this company should do good. My only concern here is on their BNPL segment. So hold on, let me just look at their balance sheet and see what have they done with their BNPL so far. Did they take any write-downs? Balance sheet. Yeah, so you see $11 billion of a goodwill. I think most of this is coming from their acquisition of Afterpay, which is I guess in my thesis is the only negative factor that I have, and it's a big factor, is they overpaid for acquisition of Afterpay. And now we have $11 billion of just goodwill sitting on the balance sheet. Other than that, I think, I'm happy with what we're seeing in Square. But if Afterpay doesn't work out, BNPL doesn't work out, there will be short-term headwinds on this one because of the large amount that they had to pay to acquire Afterpay. That bet could go wrong. All right, let's finishing it up. Next week, earnings season is still very much happening. I think maybe week after next, it might slow down. So what am I watching next week? One is Palantir. Palantir reports on Monday morning. So I'll have to spend, I don't think, a lot of time on Monday evening. So what I want to see in Palantir is the commercial growth, segment growth. How are they doing with their commercial segments? Because that's my thesis behind it. If the thesis get busted, then I'll get out of a Palantir stock. But so far they've been doing better in terms of increasing the revenue that comes from a commercial segment. Will watch Walt Disney to look at how their streaming growth has been and what's happening to their revenue from parks, not just Asian, let's say outside of America. Right. Third is Affirm, because I want to look at the health of BNPL. Now Square, we call it Block. They call them a Block, no more Square. The Block has got other businesses, right? Cash App and other stuff. So I really don't know what's the impact of the whole BNPL. So health of the BNPL segment, Affirm is another company which is only BNPL. So I do want to look at Affirm and see what's happening in the buy now, pay later stuff, right? What's happening in this segment? And because that's that would be could have impact on Square. Trade Desk, what I want to know is, given the stuff that we have seen in Snap, Meta, Google, that the companies that are dependent on advertising, they were decimated in this quarter. Will Trade Desk be able to withstand? Probably not. Who knows? But then you don't know what guidance they may come up with. So I do want to see whether it's gonna go through this, whether they're able to withstand these headwinds. Number two, I do want to see if they're talking about their open path initiative and what's the acceptability of open path initiative among their customers, and any kind of a tailwind. What kind of a tailwind do we see coming from this next initiative, which is open path initiative? Okay. Next is Unity. I want to look at a Unity. Nope, this was for Roblox, but I do want to look at a Unity because, again, one of the metaverse kind of a company. If metaverse is a thing, then Unity and Roblox will be two companies that will do good. Next, look at a Coupang. I want to focus on revenue growth and active customer growth. Coupang is an e-commerce company focused in South Korea. This is a company which will deliver you the stuff. You order it before midnight, and before you wake up, it will be right outside your door, which is what creates stickiness among the customers. If you look at a customer cohort, customers stay longer because once you get used to that kind of a quick delivery, not gonna go back. Then 2-day delivery will seem you so slow. Even 1-day delivery will be so slow when you can order it overnight and pick it up right outside your door in the morning. So that will create a lot of customer stickiness. So do want to see if revenue growth is happening and what's happening to active customer growth. Next is Neo, which I want to watch, is what's happening on the European side. Right? I think it was the last quarter or a few months ago, they opened a new office in Europe. They want to focus on their expansion in Europe. So do want to see how that's behaving. And domestically, you want to also look at what's the growth in the battery charging stations, etc. And lastly, Doximity, which is a social media company for healthcare professionals, very focused in a particular segment, and would want to see what's the growth in that post-COVID. Was it just a COVID bump? Of course, after COVID, the stock has gone down like any other social media company. But the fact that they were actually profitable and growing their user base, so do want to see what's their continuously growth. So these are the companies I'll maybe next week I want to see once they report the results, we'll get some time to review this. Will Coupang go down like Amazon? I have no idea. I mean, it's impossible to predict what will happen to the stock after the earnings announcement. Intel, remember Intel, they had announced they didn't meet revenue expectations, they didn't meet earning expectations, stock went up. Airbnb, best quarter ever, best profitable, and tons of cash flow, stock goes down. So there are tons of stuff that I can't tell. Will be impossible to predict what will happen after earnings. Even if you're a CFO of that company, you have no idea how the market will behave after you're done with your call, announce the results and have a call with analysts. So what chance do I and you have to predict how the stock will behave? Though everyone wants to predict. I'm not just speaking on it, everyone wants to know what will happen. Because it thinks that we feel that it has given us some power, but the fact is, it is impossible to predict, especially after earnings, what would happen. After the stock has moved, we will see everyone coming and justifying why that has happened. But prior to stock movement, no one is able to put together all the variables that impact the stock movement and provide a weightage on it, saying, okay, if they say this about a guidance, stock will go down by this much. Or if the previous quarter result is this great, this is the weightage of it. There's none of that exists. So it's impossible to, I don't know whether it'll go down or not. So I don't want to misguide you because I have no idea. No one has. And that's the answer I'm sure you don't want to hear, because you go to anyone else, you will actually see an answer with saying, yeah, I think it will go down, or yeah, I think it will go up. The reality is, it'll be pure 50-50. If I say anything, it's just a guesswork, which is yours is as good as mine. Cool. All righty. So, okay, I see a couple of questions. I'll see if it caused laid off employees are still future customers. I think that's with respect to the Airbnb. Square stock is down to 70 at the time of deal to 60 now. So they effectively paid 1/4. When did they close the deal? I remember. Square acquisition. Oh, they closed it in January 31st. Oh, sorry, it says January. So they closed it on in January. So they didn't pay. I mean, January is where the Square stock at January. So look at, if they closed it on January, they still paid through their nose. Or maybe I think they announced it in July. John said it will be on YouTube. YouTube, it will be delayed by a few weeks. So John, I mentioned that it will be on the website by tomorrow, because that's something which yeah, so I did talk about it. It will be on my website by tomorrow, before, let's say before Monday. So okay, yeah, so either today evening, if my family doesn't drag me to some plan, which I'm not aware of as yet, but you never know. I might have to go somewhere. If not, then tomorrow I'll definitely go. Generally, it's Sunday morning. is free, so I use Sunday morning to do some of my long reads. Yeah, something I routine I want to share, and it has got nothing to do with investing. So if you want to drop off, feel free. What I've been doing is either Sunday evening or morning, and nowadays it's mostly in the mornings. At least for last 5-6 weeks, is I'll go and sit in either Starbucks or Pete's Coffee for at least an hour and catch up on a lot of reading. And that Sunday morning routine so far has been working out. Maybe if I don't do it in morning because sometimes we want to go for a hike or something, then I try to do it in evening. But I do want to spend some Sunday to catch up and read through some of the stuff. Square seems to be correlated with BTC, not too much. That's why we looked at the non-Bitcoin revenue. Non-Bitcoin revenue was also up 35%. So eventually, it might be related to all risk on assets, right? So the statement Square seems to correlate it because, hey, NASDAQ seems to be, BTC seems to be correlated to the NASDAQ. BTC seems to be correlated to the growth companies, and Square is a growth company. So when it is a risk on, every risk on assets go up, which means all your Squares and the PayPals of the world, Palantirs of the world, Ubers of the world, all the risky growth companies will go up. So is the BTC will also go up. So that might be a correlation, but we did look at their revenue growth outside, of a BTC, because BTC is volatile. Even non-Bitcoin revenue was up 36%, which is still a decent one. Romesh says MU, which is Micron, AMAT, RCX is going up. Oh, they were all down earlier. Now they're going up. Semiconductors. Oh, so after a long down, now they're moving up. Semiconductor is cyclical. My semiconductor play is only Intel and ASML. I do want to get it, but again, I don't want to add any more ticker right now. Maybe I'll pick up SMH so that I can get others as well. One ticker, maybe multiple exposure across the semiconductor industry. Is SMH is an ETF for semiconductor. What do you read? So few things that I catch up on, and then that's why I do come back and share is, one is I'll read Barron's. I used to read Barron's, but then I used to read their analyst what is it? There is a one section which analysts say whether the stock will go up or down, etc. I don't read that page. And the other thing I read is Bloomberg Business Week, because they do talk about the businesses and the business strategies around it. I catch up on that one. I will catch up on Howard Marks' memo if at the end of a month, because he publishes the memo. These are the three things which I then look at. Then, if I have more time, I look at a Bitcoin monthly report coming from ARK to see what's an overall happening on the crypto side. Right now, I have not started any book, but like in previous times, I was reading through that One Up on Wall Street from Peter Lynch, but I already finished that. I reread Flash Boys. I had read that book at least 7 years ago, maybe, or 8 years. So I reread that Flash Boys book recently. What else? Hold on, I'm just turning back and looking at the bookshelf. Psychology of Money is one great book. And I will say before reading anything, Psychology of Money, it's more about how to forget about the stocks, but how to prepare yourself to be a better investor. Because eventually what I've seen in my own experience, investing is more about us than about the stocks. Really. And you have to be in a right mind and right state to be in the stock market. Right? So psychology is way more important. Yeah. So One Up on Wall Street, Psychology of Money, and there was third one which I started. I didn't finish it, which was a House of Cards, which is going back to I think that's a Salman Smith Barney's crash, but that's one of the Wall Street crash. Oh, which psychology of book? It's from Morgan Housel. The author name is Morgan Housel. That's the author name. It's a wonderful book. And I do want to focus in the last time I also read about some of the cognitive biases I had. First of all, I added it in today's lecture. Then I realized, oh, I have too many things on today's lecture, so I skipped that. But it talks about our individual psychological biases and how it impacts our investing. Cool. Alrighty. Yeah, I mean, it's 1 hour. No, okay. Flash crash. I think I've seen the. Is that the with Peter Navarro? London trader, yes. Not Navarro, Navinder Singh. Yes, so I actually read. I have not read. I think I have. I've seen the documentary, and after documentary, I also borrowed its what do you call audiobook. Flash crash. Yeah, it's a good account of how a lone trader working off a parents' house in suburb of London, nondescript place, was able to bring down that flash crash. Yeah, it was a good read. Navinder Sararo. All right. I guess that's it for today. Still, earnings season is there, so market could be volatile, but how do we care? It's just 1 week, and we'll survive that as well. Just let's make sure we don't take any panic decisions. If you want to do something, just give it a day and then say, do you still want to do that thing or not? Just postpone your decision. And in the heat of the things, we are never able to think rationally. So, all right, I'll stop right here. And yeah, we'll talk again next week. Have a wonderful, wonderful weekend. Bye-bye.